2026 has just begun. On the surface, the US stock market looks calm, investors aren't rushing higher, and there's no obvious sell-off either. But the real risk isn't on the screen. Many people have already started using the first few trading days of the year to project the direction of the entire year. Let me put one sentence up front. The first day's move has never been a signal. It's simply a post-reset probe after emotions are cleared. Hey everyone, this is Frank. Today is January 4th, 2026. Every year when the market opens, it enters a phase that's extremely easy to misread. People rush to find a starting point, trying to decide whether this year will be bullish or bearish. But in reality, the first trading day of the year mostly reflects capital reallocation, not the start of a trend. Looking at the actual performance, the first trading day of the year saw the three major indexes finish roughly flat. The Nasdaq pushed higher intraday, but quickly pulled back. This structure doesn't signal bearishness. It tells you that chase buying is weak. Historical data has repeatedly shown that the first day's gain or loss has almost no stable predictive power for the full year. It's simply a brief test after capital resets. That's why, in my view, today is not a starting signal at all. It's just a probe after emotions reset. Using the first day to define the entire year is like judging a whole bottle of wine by the first sip. It's very easy to get it wrong. Right now, what matters most isn't guessing direction correctly, but not letting the first day's fluctuations throw off your rhythm. From a sentiment perspective, the market is far from euphoric. The put divided by call ratio has rebounded to around 0.92, entering a mildly bearish zone, and still well away from extreme greed. Historically, markets rarely form systemic tops under this kind of sentiment backdrop. True tops usually occur when sentiment is extremely one-sided and bullish voices dominate almost unanimously, not during phases like this where disagreement still exists. This is exactly why I've been saying that it's too early to talk about a market top. You can be cautious, but there's no need to panic. The market right now looks more like it's digesting prior gains, not entering an irrational end stage. If you treat this phase as a pre-crash signal, you risk getting shaken out before the real trend even begins. From a technical perspective, QQQ is still trading within a clearly defined converging triangle. Both upside and downside ranges are being compressed. So far, the lower boundary has not been decisively broken, which means the structure remains intact, and the possibility of an upside resolution is still on the table. As the holiday period ends and capital gradually flows back in, the market may deliver a directional decision over the next 1 to 2 weeks. So my stance right now is very clear. This is not a place to be blindly bearish, and it's also not a place to aggressively chase longs. This looks like a wait for confirmation phase, not a bet heavy phase. If you feel compelled to pick a direction right now, that's more emotion-driven than signal-driven. The highest probability trades usually appear after direction is confirmed, not at the very end of compression like this. At the sector level, divergence is becoming the main theme. Semiconductors and memory, more infrastructure-oriented areas, remain relatively strong, while AI software and application layers are under clear pressure, largely due to concentrated profit-taking from earlier gains. From a valuation perspective, software remains in a time-for-space digestion phase and does not yet meet the conditions for a broad-based restart. Here's a very important signal I want to make clear. 2026 will not be a year where all AI goes up together. Sustained capital will only flow into the segments with the highest certainty and the clearest cash flows. The remaining story-driven assets are more suitable for tactical trades, not long-term heavy positions. This year, choosing the wrong direction is more dangerous than missing a rally. In small caps, the classic January effect is starting to show. IWM is clearly outperforming the broader market, while small cap names tied to nuclear energy, aerospace, and crypto are seeing sharp rebounds. The drivers here are not sudden fundamental improvements, but a combination of institutional risk budget resets, overcrowding in large caps, and concentrated short covering. But let me be very clear. This looks more like a trading opportunity then a confirmed trend reversal. You can participate, but you need to understand exactly what you're doing. This is a structural trade, not the beginning of a new bull market. If you mistake this type of rebound for a long-term thesis, you risk giving it all back once liquidity fades. From a historical seasonal and 4-year cycle perspective, there are indeed similarities to certain past years, but those comparisons can only serve as background context, not as templates to copy. Entering 2026, the number of variables has clearly increased, including policy uncertainty, shifts in the monetary path, and external disruptions, all of which are likely to amplify market volatility. In my view, the most certain thing about 2026 isn't direction, it's volatility itself. This year doesn't belong to people who want to sit back and wait for markets to rise, nor to those who want to gamble on one big bet. It belongs to traders who can repeatedly execute within volatility and strictly control risk. Taking sentiment, structure, and sector rotation together, the current environment is not suitable for full exposure or high leverage. The market is more likely to move in a segment, confirmation, advance again rhythm, rather than a single, accelerating trend. That means execution requires more patience and discipline, not the pursuit of short-term excitement. So, the core message of this episode comes down to one sentence. 2026 is a trader's year, not a gambler's year. Don't go all in, don't lie flat, don't bet blindly on direction. Wait for confirmation, control risk, and participate in segments. That's the more realistic way to survive. I'm Frank, and we'll continue breaking down the structure, step by step.